Hello, welcome to Accounting 2010 Chapter 15 videos. Video 3 of the financial statement analysis will deal with the horizontal analysis. In videos 1 and 2, we talked about the SEC and EDGAR and how to find the publicly traded companies that you will be performing the annual financial report analysis and how to navigate within EDGAR. In video 2, we talked about a vertical analysis, and in video 3, we're going to be conducting a horizontal analysis for our company, Roadrunners Roost. In a horizontal analysis, we are going to be looking at how our company did from year to year so we can see if we are improving in our sales, if we are improving in keeping the cost of our goods sold down, and are we improving in what we have for an overall net income at the end of the day. And so for Roadrunners Roost, we're going to be looking at 2015 and 2016 and comparing those 2 years. As you can see in Roadrunners Roost, in 2016 we're projecting out. In 2016 we had net sales of $78,252 compared to 2015 net sales of $69,358. In order to conduct and perform a horizontal analysis, we need to subtract the base year from the next year and see what was our dollar amount of change. In the case of 2015-2016, net sales increased for Roadrunners Roost by $8,894. If we divide that $8,894 into the base year, so we subtract the base year from the next year, and we divide that dollar change into the base year, we will find that we improve sales by 13%. This is important in order to break it down because simply looking at the dollar amount, we're looking again to some extent at dollar value bias, we can't really tell what that percentage of change was. That 8,000 a decent amount of change or wasn't it? Because 8,000 may not seem like a lot of money, but when divided into the 69,358, we see that's a 13% increase, which would be a pretty decent amount of an increase. Then if we go on to the cost of goods sold and we subtract the 13,656 into the 14,252, we see that we had an increase of only $597. That's an increase of only 4%. So while we increased sales, we held down the cost of our goods sold to leave us with a change of a 15% increase in gross profit. And if we continue on performing the same function of subtracting the base year into the newest year, we can see that we had a decrease in our operating expenses. I bet your managers, your supervisors would think that was pretty great. And that would give us a combined change of a 44% increase in operating income. Now, if we look at other expenses, we see that other expenses did increase by 51%, which may be a lot of money, but if that 51% was used to leverage perhaps a building, we're paying more in interest because we decide to expand our operations. It would depend on what caused that 51% increase. The bottom line is we increased our net income by 43%. If you're up for a promotion, if you are looking at bonuses, that could be considered a very decent increase. So we can go ahead, this is the income statement. We could perform the same kind of an analysis on the balance sheet and seeing if our assets increased, did our liabilities increase, decrease, and we would do it the exact same way. We would take the 2015, subtract it from the 2016, look at the dollar value change, convert the dollar into a percentage, and do an analysis on the balance sheet as well. So in video 4, we're going to be looking at the third type of analysis, that is the ratio analysis. There are a number of ratios that we can use to analyze our companies, but for the purpose of this video, I'm going to be demonstrating the kind of ratios that you will need to perform your financial statement analysis project, and that will be conducted in video 4 for Chapter 15.